Well, hello, everybody, and welcome to the April podcast. And I am very excited today. My name's Angie Hughes. I'm with Producers XL. And I want to thank you for joining the long term podcast where we kind of just talk back and forth about trending things in the long term care industry. And it's April, right? It's traditionally it's the tax month, and I don't think Larry Moore is with me today, and he's with National Guardian Life. I don't think we probably could have planned our podcasts a little bit more accordingly. That we're going to start talking about some business funded long term care. So as we think about filing our taxes and getting all of that paperwork done, even though we got some extensions this year, um, I tell you, I have seen, and it's just what a great coincidence, right? That not to make this the National Guardian show, but you guys just launched out a new product as well that's got a 10-year guaranteed product all the way through those 10 years of guaranteeing those premiums. And that fits quite nicely into the, that business funded space. And so Larry, I'm really starting to get a lot more questions about it. And I'll tell you one of the catalysts too, which you're going to know a whole lot about because you happen to be in the state of Washington as well, but that Trust Act. And I got to tell you, earlier last week, I had a conversation with a dentist who owned his practice in Washington. And because of the payroll taxes that are going to be handed down, he wanted to know what he could do outside of that. And so we kind of had this whole conversation, and what wonderful icing on the cake when I said, oh, well, if you're the business owner, you have the opportunity to deduct some or all of those premiums. And so that definitely perked up his interest. I'm curious, what are you guys seeing? Are you seeing any activity with the new launch of the product, with it being April tax month? What are you seeing on the corporate side of things?
That's a good question. Thanks for having me too, Angie. Tax month is typically an interesting time to bring this issue up because I can tell you, having been directly involved in this market segment for many years myself, especially my time at Marsh McLennan, business owners or people that run businesses don't know about this. And, you think about the idea of a business looking to reward and retain their best talent or looking to recruit talent in an era where salaries are, fairly similar, benefits are ultimately the common denominator. So when we talk about long-term care planning and the idea of a tax advantage benefit for long-term care, what's so compelling about the story is that, first of all, you've got a product under IRS code 7702B that upon claim pays a tax-free benefit. I mean, we're talking thousands of dollars a month that would be either reimbursable or payable to you depending on the kind of product you have, where not one penny of it's considered taxable income. And then taking it a step further, where the business can actually pay for part of or potentially all of your premiums, it becomes a valuable and very attractive value proposition. And, taking a step back and looking at the business's role and then looking at where long-term care insurance fits the bill, it's real important to remember who your constituency is, and also keep in mind that our industry has done itself no favors in terms of positioning this product as a product for seniors as opposed to younger people, right?
Mm-hmm. Yeah,
So,
definitely.
So when we think about that, when I was directly involved in these cases, I went straight to that whole issue. And I love to, for your people that are listening, what I just strongly encourage you to do after this call is take some time and identify in your client base individuals who either own a company and employ people or not, it doesn't matter, or run one, right? Maybe they're a senior vice president or president of a company. That's your audience. You don't need to turn your business upside down to market to a whole new segment. All you're doing is kind of finely tuning your marketing arrow, so to speak, and just diving into your existing database and looking for an opportunity to present a concept to that client that I can assure you, most of them, if not all of them, haven't even heard about. And I think that's what's so interesting in the executive benefit space. Very few people know about this, and those that do know very little about it. So that's my first suggestion. Don't worry about this as us coming to you and saying, here's a whole new market, segment to turn your business upside down with. it's right under your nose. It could very well be the people that you're doing business with, and
Oh, and
identify it. Go ahead.
yeah, no, I was going to, Larry, you're absolutely right. Because, when we start talking about executive carve out and the business owner, market and tax deductibility and tax-free benefits, it can feel very daunting and overwhelming. And I will tell you, I work with a lot of property and casualty agents, and it is literally just something as easy as, remember, it's the same solution, right? Long-term care insurance, a long-term care policy is the same solution for a business owner as it is for just a person that doesn't run their own business. But when you stop and actually reflect that back to yourself as, oh, I am self-employed as an insurance agent. I own my own agency as an insurance agent, and I want to buy this benefit for myself. How does that play out? So think about how you would sell it to yourself as your own employee, your own self-employed, your sole proprietor, S corp, however you file those taxes. We're not asking you to go to whale hunting, right? We're not asking
Right.
you to go to Enron and sit in a boardroom and present to really high level executives. This is something as easy as going to the folks that you have commercial accounts with, because those are your business owners. Those are the ones that are insuring a couple of trucks to do the landscaping business. There's, it doesn't have to be so daunting. Like you said, we're not asking you to bring yourself into a whole nother niche market. You actually have that. And I would say, even before you look at your clients, look at yourself. Am I able to buy this on myself as my own employee, employer, as my own business, and deduct my own benefits? And it's one of those things that we need to have those conversations with ourselves, because then you know how you're going to turn around and have that conversation with your clients and your customers about that. And what other insurance product can the business pay for it? The benefits received are income tax free, and the premiums are tax deductible. That is just a win-win-win. And you don't get that in many products. Does it parallel a little bit to disability income? Yes. However, with disability income, if the employer pays for it, those benefits are taxable. So this is not the same thing. Like you said, there are some tax codes out there that you can take advantage of. And with this being kind of the tax month, it would behoove everybody to have that conversation next time you sit down with your accountant to crunch through your numbers. Just ask the quick question and get a feel for what that looks like. We're not asking anybody to be CPAs or tax preparers, but most certainly understand where those opportunities are. Because, like you said, Larry, it's really uh, it's a highly untapped market, and those that actually have found a way to get in there and have those conversations, they do very well. I have a lot of folks that say, Angie, I try to sell long-term care insurance, I just can't. I cannot fit in there. Well, maybe it's that whole touchy-feely thing, right? Maybe it's the whole idea of trying to convince somebody the need for extended care planning because someday you're not going to be able to take care of yourself. Well, what if it was a business conversation? What if we didn't have that conversation about the whole touchy-feely and we went into brass tacks and just kind of went business owner to business owner, just do it B2B and see where
Right.
that lands?
Right.
There's a ton of opportunity there. And I just think sometimes we make it so much bigger than it really needs to be.
I totally agree with that. In fact, let's talk about it in very simplistic terms, right? If you're a C corp, it's real simple. It's 100% write off as a business expense, the premium. It's real simple. S corps, LLCs, a little different. But actually, there's a lot of misunderstanding about those entities too. So, for instance, if I'm a sole proprietor and I want to buy it on myself, yeah, it's treated as a pass-through entity. And basically, what I'm looking at is a way to pay the premium through the business using business assets. And if I stop right there and still subject myself to the imputed income tax, that's fine. That tax is a lot less than the
Mhm.
premium I would have paid without taking business assets to do it. However, you can also gross that bonus up to cover the imputed income tax as well. It's not an uncommon thought, but employees in that, sub S corp arrangement are still treated as like they are in a C corp. They can
Mhm.
write off the whole cost of that premium as a medical deduction. So,
Mhm.
but I think more importantly, let's kind of go back to something you touched on that's really important. In this case, smaller is better. And what I mean by that, you mentioned, going after the Enrons of the world, the big companies, big voluntary deals. You don't want those.
Mm-mm.
You want to go to the market, which we call the executive carve-out market, the small business market, where suddenly this becomes a business decision made by the people that run the company or the person that runs the company. It's not subject to a HR committee panel and then gone through the bureaucracy of a major company. So what you're looking for are people who, especially small businesses where people have unique talents and unique capabilities that are vital to that business. And what a wonderful way to reward them. And let me kind of just go, real straight to the point you mentioned too, Angie, about kind of like disability. And this goes back to my earlier comments about what my industry has done in terms of positioning this product that I think is a bit not misleading, but not taking full advantage of what it is we have. We know there's an incredible tax advantage here, which is exciting. But let's talk about long-term care insurance. If you asked your client point blank, when you think of long-term care, what are the first thoughts that come to mind? And Angie, what do you think that would be? If you and I were talking, I said, when you think long-term care, what are your gut reactions to that?
Nursing home.
Right. And we're talking not about young, healthy, vibrant people, right? We're envisioning people at the end of the line, right?
Right.
And that's kind of been how our market has been built. And when you really get down to it, the way long-term care insurance works at the time of claim, it's not about how old you are. It's not even about what it is that caused the disability. It's simply, do you meet the eligibility criteria, regardless of your age? And, the two criteria, you're physically disabled, which are measured by your ability to perform 2 out of 6 activities of daily living, or is there some sort of cognitive loss, brain injury, or some sort of, health-related cognitive issue, however you look at it. When you think about younger people in their 50s, early 60s, right? They're preparing to retire. They're looking to retirement. And I'll throw 40-year-olds in there as well, right? They all have DI, but we know that DI is kind of limited to the extent that it's replacing a portion of your income.
Right.
Long-term care insurance can augment that, meaning that if you were banged up in an accident sufficient that you not only trigger your DI, but meet the eligibility criteria of your long-term care policy, you can draw a tax-free benefit there. And so you look at this as a perfect marriage to enhance someone's DI coverage. But then let's go to the other end of the spectrum. When I'm thinking about retirement, right? I got people in their early to mid 60s where pretty soon the cost of maintaining a DI program becomes pretty prohibitive. Long-term care insurance, in many cases, becomes the DI for the rest of your life. At that stage, you can supplant a DI program or minimize a DI program and bring long-term care insurance into the picture there. So the company is looking at this from, you're valuable to us, you're critical to the success of this company. We want to provide some sort of legacy for you, meaning that this is something that you're going to take beyond your years with this company, and basically becoming the DI for the rest of your life, right? And that's where this, I think, becomes very attractive and compelling to a business owner or a company looking to reward its key talent. And we keep talking about key talent, and the question is, do I have to treat this like an ERISA product? And the answer is no. It doesn't even apply to ERISA. It's IRS code 7702B. So that means it is a business. I don't have to offer it to everybody. I can offer it to who I decide to offer it to. The old term was discrimination. I like to say you can be selective. You can legally be selective, right? So there's a lot of flexibility you have with this benefit.
I just think it's fantastic. And I think, especially as we're watching the population age, I think now is the perfect time to not be afraid to talk to folks in their 40s and 50s because they are experiencing it in their families. I mean, flip on a TV set, pull up a Facebook page, watch a Twitter account. I mean, you're seeing all kinds of folks with disabilities and stay tuned in with us. I know we're still talking about long-term care insurance, but if you kind of change your mindset around, it's okay to talk to younger folks about it because a lot of times they're watching this happen in their own families. It's a great reward for them if they are part of the succession planning that's coming up in a business and the company wants to reward them for that. There's absolutely no reason why we don't start them out with a benefit. And then as they age, if their health provides, then they can obviously add to that benefit. And so I was just talking to a gentleman the other day, 46 years old. So obviously they're in the younger demographic. He spent 2.5 years with his mother in claim for long-term care. And he inherited a big IRA, and he wants to find a way to make sure that him and his wife have coverage. And so we had that conversation around, well, maybe we don't solve the whole thing right now because we've got 2 kids in college and retirement, and I'm in my accumulation phase. You can start with small benefits, things that are still affordable to them. But if the employer's paying for it, it then turns into a business conversation to the employer that's writing that check, because then it does become a deductible item to the business expense line. So it works out really, really well. And I just don't think, and you're absolutely right, Larry, as an industry, we've done probably a not so good job of making long-term care insurance a yucky conversation, a horrible negative connotation in our minds, when in fact, you really almost got to start planting the seed for extended care planning. Broach that conversation in their 40s, in their early 50s. Are they going to bite? No, but at least they will have heard the conversation. I mean, how many people decide on a Saturday that they're going to go buy a car, and they know
Right.
exactly what they're going to get, and they're going to go buy the car with every single bell and whistle on it that they want? They don't. They read reviews, they look at things, they talk to people, it becomes topic of conversation. So it's okay to plant that seed. And then when you get back into the whole business arena thing, then it becomes a little bit more of a different conversation, but certainly doesn't have to be a complex conversation. Um, and I
No.
kind of feel like myself, when I dig into tax codes and all the things that they can do, you can definitely overwhelm yourself with it. But if you stay at the surface level of exactly what the law allows you to do, I think you would be absolutely amazed at the opportunities that this presents to you when you stop and think about the clients in your book of business. I can't have a conversation today with an agent about, hey, Angie, I need a long-term care quote. I never, ever miss the opportunity to say, does this person file any, self-employment wages? I mean, are they self-employed? Are they a business owner? Do they own a business?
Right.
Because
Yeah.
you'd be amazed at how many people do side jobs, right? If they're filing self-employment, we need to have that conversation. I want to not miss that opportunity about, hey, some or all of these premiums. It was interesting to me last week. I also had another conversation with a gentleman. I don't bump into C Corps a whole lot. And I was just having a conversation with some folks, 69 years old, somewhere in that ballpark. And they kind of had kicked the can for several years and decided that, hey, I think I'm probably going to sell the business. I probably ought to be thinking about this. And I said, well, you're a business owner. Oh yeah. I said, because I assumed, I said, so S Corp? Oh no, I'm one of the old ones. I'm a C Corp. And I mean, my jaw, like I had to pick my jaw up off the desk. You just don't run into those, for me anyway, very often.
Right.
And I said, you realize 100% of yours and your wife, since you are the sole owner of that C Corp, you can write that through your business at 100% tax deductibility, and the benefits received are income tax free. And you just saw the twinkle. And I
Yes.
don't know if that was never brought up before in conversation with him. He never realized it. I also do acknowledge that, right, the businesses have to be profitable. I mean, if the business isn't doing well and there's not, for the C Corp, retained earnings out there, or the S Corp's not pulling down a profit, they're going to have a hard time adding another expense item. But to me,
You
this
know,
is a no-brainer.
go ahead. I'm sorry, Angie.
No, that's okay. Go right ahead, Larry.
I was going to say, to kind of put this in perspective of exactly what you're talking about. Buying talent in the marketplace is expensive. And, I remember in times this market looking really attractive in recessionary periods. And why is that? Well, it's a lot less expensive to fund a premium that's tax advantaged
Mm-hmm.
against the business, as opposed to increasing payroll expenditures
Mm-hmm.
during tough economic times.
Yep.
Even more attractive during great economic times. So, when you look at, for instance, a 55-year-old, I'll just throw in 55-year-old male, $150 a day, 3-year plan, just a basic plan.
Mm-hmm.
The annual premium is $1,800 a year, but the pool of money is over 164,000, almost 165,000 of tax-free benefits. So when you're a business person, you look at, wow, there's $1,800. I can treat part of or all of that as a business expense and write it off. I've
Mhm.
just given my employee 164,000 today tax-free.
Mhm.
Pretty interesting when you look at it from that perspective, And I think that's ultimately when we put ourselves in the eyes of the individuals that are making the business decisions to do this. That's why it's such an attractive strategy. And I can tell you, nobody knows about it. That's what's really interesting. So, to your people out there that start looking at their own database, also go into this knowing that you're going to bring up a subject that no one's ever brought up with them before. And suddenly you're going to look like a real insightful resource to that individual.
Absolutely. Yeah, couldn't agree with that more. And and I can never just stop to say, we have to think about that. If we're running our own businesses, we most definitely have to start thinking about, how would I want somebody to did anybody present long-term care insurance to me that way? I'm a 2% or more shareholder of an S corp. Did anybody tell me that my business could actually pay my premiums?
Right.
Um, so it's one of those things that there is so much opportunity, but for whatever reason, so much reluctancy. And Larry, like you said, this is not a new concept.
Mm-mm.
This has been around for a really long time. I feel like, again, maybe as an industry, we've done a disservice to it by making it something bigger than it is. We don't have to sit around a boardroom making a presentation to a board of directors.
That's
Look at
correct.
your small business owners. I mean, those if you actually think about the economics of society, right? Those small business owners, they love looking at things that benefit them and are tax favored. So
Yeah.
it's definitely a wonderful opportunity. Larry, I want to ask if you had anything else you wanted to add around this.
Sure. One final thought about this, because you mentioned guaranteed 10 pay, which is what
Mhm.
we do have in most states now, meaning that if you have a 10 pay premium with us now, it's guaranteed from day one to never go up.
Yeah.
So that's kind of a nice feature. The majority of these cases are 10 pays. So
Yeah.
kind of again coming back to the perspective of people listening in on this call who have a book of business, these are really attractive compensation opportunities because you're going to get the bulk of your income in a big way up front. Um, the company looks at it from a standpoint of, I'm willing to pay for it for 10 years, 1 year at a time. And if this employee decides to go rogue and leave, guess what? It's all up to them. No
Yeah.
skin off our nose. And so there's obviously a lot of ins and outs to this that if you really want to get into the weeds, you can. But I think at the end of the day, just take a step back, look at your book of business, look for people who own companies, run companies, or play a major role. Like even if you have a
Mhm.
client who's a CFO, guess what? That individual is a decision maker, right?
Mhm.
And what I love about these cases, especially carve outs, is that they're easy and they're fast.
Yeah.
They're easy and they're fast. You're not dealing with hundreds and hundreds of people. You're dealing with 5, 10, 8, 20 people. And they happen fast. They compensate quickly. You do have an underwriting concession reality that doesn't exist anymore. So you do have to deal with the underwriting side of it. But at the end of the day, again, we're selling an augment to an existing DI plan
Mhm.
and ultimately at retirement, the DI for the rest of that employee's life.
Right.
And I think about the premium versus the payroll expense to increase compensation. Suddenly you've got a real attractive value proposition that makes life better for
Mhm.
your employees and your business.
Larry, were you running an illustration on that 55-year-old 153 year at $1,800?
Yeah,
Just out of curiosity, throw the 10 pay on there.
you got it. I'm going to back up.
I got, not that I don't think women are business owners because they are, but I'm telling you, male rates in long-term care are great.
So if I bring you down to a 10 pay for the 55-year-old male, right?
Mhm.
And keep in mind, it's not our joint rate.
Right.
We can do couples on this too, by
Yeah.
the way.
Yeah.
But if I look at that premium alone to the business for this individual, now you're looking at $5,400 a year.
See, you're under $55,000 all in over a 10-year period. What an amazing
Yeah,
benefit for that employee slash owner, however it's structured. I mean, tax favored to the business and a massive benefit. I mean,
Yep.
it is so cool. And so when you're in that business space, right? Even when we start talking about underwriting concessions, usually you're in a little bit of a younger demographic. So a lot of times underwriting's not so much of a concern as if we waited too long and we've
Yep.
developed some health conditions. So it is actually a very exciting market space to be in. But with that being said, don't think that it's an unattainable, unreachable, really complex space to be in.
Right.
Like you said, Larry, take a step back. Think about all your business owners, your small business owners, your self-employed individuals. Um, those folks have just as much opportunities as, the folks that are the CEOs and CFOs and CMOs and things of that nature. Um, they're also obviously an opportunity inside of that. So,
Yeah. And, just kind of in summary, what are your ideal business clients? Well, think about where there's highly compensated people, medical groups. Maybe it's an
mhm,
anesthesiologist group, dental groups, law firms, engineering firms, out in your neck of the woods. There's a lot of still family owned or semi private agricultural businesses,
yeah,
farms, where disability could be a daily reality for those people.
yep,
What a wonderful way to complement that. So just think about where the money is,
hmm,
and then ultimately that's going to help drive your direction. And again, you'll be the first one to come up with the idea. Nobody else has ever talked to them about it.
yep. Agree with that. Larry, I can't thank you enough for joining me on this month's podcast. We've always got exciting stuff. Our timing has just been impeccable this round. And next month, we've got another really exciting topic talking about, legacy and gifting strategies and things of that nature. So looking forward to that. I want to thank you for joining me on this month's podcast. And thank you for everyone else that joined us. And we will talk to you next month. Thank you very much.
That sounds great. Thanks for having me.
All right. Bye, Larry.
Bye bye.